If you want to build anything that's meant to last, whether it's a building, a career, or a business, you absolutely need a blueprint. It's that master plan, right? It shows you what you need, where everything goes, and maybe most importantly, what it's all really going to cost. In the world of business, understanding cost isn't just about accounting. It's the economic blueprint for every single decision you'll ever make. So let's kick things off with a huge question. I want you to picture an entrepreneur, just full of passion, launching their dream startup. We can all see the obvious costs, right? The rent check, the invoices for supplies, the paychecks for the first few employees. These are the numbers that get written down. But is that the whole story? What does it truly cost to bring that dream to life? And here's the secret. This is really the core insight of all of economics. The money you spend is only chapter one. The real cost, the one that shapes every single strategic move, isn't just about the cash going out. It's about the other roads you could have taken. It's about the opportunities you sacrificed. It's all about what you give up. And that leads us right into the foundational concept for this whole discussion: economic cost. This is not just the money leaving your bank account. See, for an economist, the cost is the total value of every single resource you use. That means it includes the direct, out-of-pocket payments, we call those explicit costs, and the value of the next best thing you had to give up, which we call implicit costs. Okay, so here's our blueprint for today. First, we're going to break down the real cost of business. Then, we'll get into the fascinating clash between how accountants and economists see the world. After that, we'll look at short-run constraints, visualize the beautiful logic in the dance of the cost curves, and finally, bring it all together to see how this stuff works in the real world. So let's start our investigation by uncovering those hidden sacrifices. To really get at economic cost, you have to think like a detective, okay? You're looking for the clues that would never, ever show up on a normal spreadsheet. First up, the obvious ones: explicit costs. Just think of these as any cost that leaves a paper trail. They're the direct out-of-pocket payments you make for stuff: the rent for your space, the salaries you pay, the bills for your materials. If money actually leaves your hands for it, boom, it's an explicit cost. They are concrete, they're measurable, and they are the entire world of financial accounting. But this is where the plot really thickens. The hidden part of the blueprint is the implicit costs. These are the super powerful opportunity costs of using resources you already own. They're invisible because no money actually changes hands. But trust me, they are profoundly real. Our entrepreneur is the perfect example. If she could have been earning a $150,000 salary working somewhere else, but chose to start her own company instead, well, that foregone salary is a huge, very real implicit cost of her business. It's like the ghost of the career path she didn't take. And this gets to the absolute soul of economic thinking. Every single choice you make, from starting a business to just spending an hour watching this explainer, it comes with a hidden price tag, the value of the next best thing you could have been doing instead. That's opportunity cost, and I'm telling you, once you start seeing it, you see the entire world differently. So this huge difference between the visible costs and the invisible ones leads us to two completely different ways of looking at a business. It's basically like they're keeping two different sets of books: the accountants and the economists. Look, an accountant's job is to track the flow of money for financial reports and for taxes. And they're great at it. Their world is the world of explicit costs, those actual verifiable payments. An economist, on the other hand, is obsessed with decision-making and strategy. And to make a good decision, you have to consider the full opportunity cost. That means you have to add those powerful, invisible, implicit costs into the mix. And here's the key takeaway. This is exactly why a business can look insanely profitable on an accountant's books, but actually be an economic failure. All right, let's make this crystal clear with a real-world example. Imagine a student trying to decide if they should go to college for a 4-month semester. Here are the numbers. We've got the explicit costs, the fees, the rent, meals, and books. But then we also have the implicit costs, the sacrifices. They'd have to quit a job that pays 150,000 rupees, and they lose out on the interest they could have earned on the money they're now spending on fees. So, what is the true economic cost of this semester? Well, to figure it out, we're going to follow 3 simple steps. First, we'll add up all the explicit out-of-pocket costs. Second, we'll find and put a value on those implicit opportunity costs. And finally, we'll add them all together. Now is a great time to hit pause, maybe grab a calculator, and see if you can figure it out for yourself. What's the grand total? Okay, the total economic cost is 241,000 rupees. Let's walk through how we got there. The implicit costs are actually pretty straightforward. the 150,000 rupee salary plus the 6,000 in lost interest. That's 156,000 rupees in sacrificed opportunities. Easy enough. Now for the explicit costs. We add up the fees, the rent, and the books. But wait a second. What about the 15,000 for meals? Now here's a classic bit of economic thinking. The student has to eat whether they're in college or not, right? It's a living expense, not an educational one. So an economist takes that cost out because it's not an additional cost of going to college. That leaves us with 85,000 in true explicit costs. Add that to our 156,000 in implicit costs, and there you have it, 241,000 rupees. So now that we've got a handle on the seen versus the unseen costs, let's switch gears and focus on a specific time frame that every business has to deal with, the short run. This is where things get really practical, because in the short run, you can't just change everything on a whim. Your hands are tied in some ways. Now, in economics, the short run isn't a set amount of time, like a week or a month. It's actually a strategic period where at least one of your inputs is totally fixed. You just can't change it. The classic example is a factory. In the short run, sure, you can hire more workers, you can order more raw materials, but you are stuck with the size of your factory and the number of machines inside. That building, that equipment, those are your fixed inputs. And this fundamental constraint gives us the master equation of short-run costs. It's really simple. A company's total cost is just its total fixed costs plus its total variable costs. Every single expense a business has during this period falls into one of those two buckets. So what's the difference? Well, total fixed costs are your stubborn costs. Think about rent, insurance, loan payments. They stay the same no matter how much you produce. Whether you make 0 widgets or 1,000,000 widgets, you still have to pay the rent on that factory. Total variable costs, though, they move right along with your output. The more you produce, the more you're going to spend on things like labor, electricity, and raw materials. They go up and down with your production levels. Understanding these two types of costs is the key that unlocks this next section, which is my favorite part, where we bring all these numbers to life. This is where we get to visualize how all these different costs interact in this, well, it's like a dynamic, interconnected system, a graceful and logical performance that I like to call the dance of the cost curves. Okay, before we see the dance, let's look at the sheet music. This table just shows a firm's costs at different levels of production, or Q. Notice how the total fixed cost, TFC, is just stuck at 125 no matter what. But as output goes up, the total variable cost, TVC, starts to climb. And from this raw data, we can calculate all the averages, and more importantly, we can calculate the star of the show. And that star, the main driver of everything, is marginal cost. This is an incredibly powerful idea. Marginal cost is simply the cost of producing just one more unit. That's it. So if making 10 units costs you 175 and making 11 units costs you 180, your marginal cost for that 11th unit is just 5. This one idea, the cost of the next one, is the engine that drives the shape of all the other cost curves. And this slide shows you exactly how that engine works. Think about it like this. Your average cost is like your GPA for the whole semester, and the marginal cost is like your grade on your very next exam. Now, if your score on that next exam, the marginal grade, is lower than your GPA, it's going to pull your overall average down, right? But if your exam score is higher, it's going to pull your average up. This simple intuitive logic is exactly why the marginal cost curve will always intersect the average variable cost and average total cost curves at their absolute lowest points. It is the mathematical turning point. But why does this elegant dance of the curves actually matter? Is it just pretty math? No way. It matters immensely because this economic blueprint is used every single day in boardrooms all over the world to make huge decisions about pricing, about how much to produce, and ultimately about whether the company is even profitable. It tells a company when to grow, when to stay put, and even when it's time to shut down. All right, let's lock in that key relationship with a quick quiz. Based on what we've just seen, at what exact point on the graph is marginal cost exactly equal to average total cost? Well, the answer is the key to efficiency. It happens at one and only one point, the very bottom, the minimum point of that U-shaped average total cost curve. This point is so important it has a name, the firm's efficient scale of production. And that brings our entire journey to its conclusion. You know, from the invisible sacrifices an entrepreneur makes, all the way to the mathematical beauty of the cost curves, understanding the true nature of cost is never just some academic exercise. It is the essential, the unshakable foundation of every single smart economic decision. It is the architect's blueprint for building something that doesn't just survive, but truly thrives.